In 2008, Vodafone's new CEO, Vittorio Calao, set about making changes to Vodafone's strategy, moving towards cost-cutting. Calao took over during the global financial crisis, and one of his goals was to reduce costs down by £1 million by 2010 to 2011, with more if needed. The savings were centered around Vodafone Europe, and the results did well, as we can see from Table 19.1 in 2006 and 2007. Vodafone's operating loss turned into an operating profit. In 2020, Vodafone has shifted its focus away from those old goals as they seem to achieve them. Now their goals are to deepen customer engagement through the likes of selling additional products and services and coverage. They also have started on accelerating its digital platform, creating chatbots to help with customers and creating an app to track data usage.
In terms of development in technology, Vodafone launched the first signature IoT tracker in Europe. The new multi-purpose tracker is called Curve, which is designed to help people to locate valuables such as keys, laptops, bags, and cars. By 2027, there will be a predicted 41 billion smart devices worldwide. The IoT sector forecast to increase annually by trillions of euros. Therefore, Curve highlights Vodafone's continued innovations through the making of smart devices and digital experiences which are connected by the Vodafone global network. Curve is lightweight and has up to 7 days battery life. Vodafone is planning for an IPO for European Vantage Tower in 2021 despite a decline in revenues due to COVID-19, and the goal is on the planned flotation of the business on Frankfurt stock market. Vodafone sees wireless infrastructures has been getting attention from the investors attracted to the steady and long-term assets. The new unit is expected to include about 61,700 towers in 10 European countries, which are likely to generate about 900 million euros of annual earnings before interest, tax, depreciation, and amortization. Vodafone has a tower joint venture with Telecom Italia in Italy and has just entered into agreement with Greece. The group CEO also mentions that it is possible that towers from Vodafone UK's joint venture with Telefonica could be added to Vantage footprint in the future.
Vodafone's financial performance has been rather rocky, with some areas showing growth and promise while others show periods of poor financial health. Vodafone's revenue in 2009 was £41 billion. This increased in 2015 to £42 billion. 5 years later, Vodafone has continued to increase revenue as the 2020 revenue was recorded at £45 billion. However, Vodafone's net cash flow over the past 10 years has been less stable, with the company posting losses in 4 out of the last 6 financial years. Similarly, dividends per share is a good indication of the profitability of a company over a fiscal period. Vodafone's total dividends per share in 2009 was 7 pence. In 2015, this rose to 11 pence, and Vodafone's most recent dividends per share came in at 9 euro cents, considerably lower than their 2018 dividends per share, which was 15.7 euro cents. This drop in dividends per share may indicate a period of poor financial health for Vodafone and an inability to withstand current market conditions. This point was backed up by Vodafone's drop in market performance over the past decade. Vodafone operates in markets all over the world, with countries in Europe and Africa being the most prominent. Since 2009, Vodafone's market share in 5 of the largest countries in these regions has dropped. Vodafone's market share in these countries was 36.6% in 2009. This has since dropped to 34.4% in 2015 and has dropped even further to 29.2% in 2020. As competition from telecommunication companies continues to grow, it is likely Vodafone's market share will continue to drop. Furthermore, the company's brand value has also been decreasing. In 2010, the brand was ranked 7th on Brand Finance's most valuable brands and was valued at $29 billion. In 2015, this dropped to $27 billion and the company ranked 22nd. This has since dropped substantially, and Vodafone are valued at $19 billion and are ranked 77th most valuable brand globally in 2020.
A few critical issues facing Vodafone have been in the Indian region. India is one of the largest telecoms markets in the world. However, it is highly competitive among the industry leaders with significant pricing pressure. The result being a significantly lower level of profitability in the region as well as an immense pressure on financing. In order to remain competitive, Vodafone have had to lower the price of their mobile data unlike any other region, disrupting their business model of One Vodafone. The merger of Vodafone India and Idea Cellular in 2018 created Vodafone Idea Limited. This merge suffered even greater losses, announcing a 6th straight quarterly loss of $903 million USD in February of this year. Not only this, but the debt owed to the Indian government's Department of Telecoms has increased over $5 billion as of last November 2019. This is due to the Supreme Court's recent rule in favour of the Indian government over the argued definition of adjusted gross revenue with telecoms providers dated back to 2005. This rule said a wider definition was to be used, and therefore Vodafone Idea were to include non-telecoms revenue and a percentage to the Department of Telecoms. Overall effects of these issues include profitability remaining low, assuming industry pressure pricing remains the same, the excessive amounts of tax continue, and the government pressure Vodafone for their owed debts. Also, it's not a good look on Vodafone as a whole being unable to profit in a leading telecoms market. This could lead to consideration to exit India and be a plausible option if matters continue this trend.
The One Vodafone program was created to centralize marketing, branding, and have a high level of coordination. A strategy recommendation for Vodafone would be opening marketing subsidiaries within the countries they wish to expand to. This will be a way forward for them, as it may be difficult to get insight to the market through having solely centralized marketing and branding in one country. Having these subsidiaries can give the business a unique insight into the market, as well as the opportunity to hire someone who is very knowledgeable and can give the business exclusive advice on how to market and brand their product to attract the target population. This is helpful because the cultural differences between the countries can influence marketing. Following from the above point, due to Vodafone's large international presence, it can be difficult for them to succeed within the different markets. This is highlighted through their issues faced in Japan, with their market being more technologically advanced. Another strategy Vodafone could adopt would be to focus more on the individual markets and adapt their business strategies and goals specifically to the country. This may require a larger focus and perhaps more costs on research and development to explore what the market is in need of. This may be done through research and development subsidiaries within the target country and giving them control to make decisions based on their findings rather than headquarters controlling the decisions. However, in the long run, the cost will be worth it. The products will have a greater chance of success as the needs have been researched and adapted accordingly.